Our last topic we're going to be covering is intangible assets. Remember intangible assets? We covered this in an early chapter. It's non-current assets without a physical substance. They often provide exclusive rights or privileges. Maybe someone cannot copy the work that we've already created. So we have the right to an invention before others have it. Useful life is often difficult to determine, but you don't have to worry about determining that. I will let you know what it is. And it's usually acquired for operational use. And that's how we're going to look at it. There are like patent trolls out there who are just in the business for collecting these patents. We're not going to be looking at a scenario like that. We're going to look at it as if a company has a patent or a copyright, it's because they need it for their business. Here are some examples of intangible assets. We're not going to be going over all of them. We're going to go over maybe around half of them. We have patents, copyrights, franchises, licenses, trademarks, trade names, goodwill, leaseholds, leasehold improvements, research and development, and there's plenty of other ones as well. For instance, customer list is another popular one. We're going to go over a few of these individually next. The first one we're going to discuss is patents. Every time I see a patent, I think of Shark Tank, where the investors are always asking if the inventor has a patent on their idea, on their invention, so that no one else can copy it. It is the exclusive right to manufacture, sell, or otherwise control an invention. We will capitalize the cost of purchasing this patent if we are purchasing it and amortizing it over its 20-year life or useful life, whichever is shorter. What this means is that if we purchase a patent, whatever costs we spend on it, we're going to put that on our books, and then we're going to, instead of depreciate it, it's going to be called amortize it. Amortization, it's the same thing as depreciation, but it's for an intangible asset. Now, patents have a legal life of 20 years. You would amortize, depreciate it over those 20 years, unless the patent is good for less years. If it's only useful for 5 years, then you would not amortize it over 20 years, you would do it over its useful life. It's whatever shorter. I always say pick the shorter one. For example, 20 years ago, we had beepers and pagers instead of cell phones. Imagine if that invention was still on someone's books and that they are still depreciating it. In that case, especially with technology, usually it's not good for that long of a period of time, for 20 years, because things are always changing so quickly. So the amount of years that it would be useful for it, that's what you would amortize it for. Next example we have are copyrights. It gives an owner an exclusive right to reproduce and sell an artistic or published work. It is granted for the life of the creator plus another 70 years. Now, there is a certain reason why it's for such a long period of time. It's because of a specific company that has one of their famous works that the copyright will run out soon, so they lobby Congress in order to have the copyright law extended. Anyone take a guess what that company is? Well, at this point is normally where I show you a video about it. However, due to a copyright claim, I can't record the video and then upload it to my YouTube account. How soothing for this chapter. Instead, please pause this video, scroll down a little, and play the video labeled Copyright Law. I have marked it as a required video in this topic. After you watch that video, then resume this one. Please do this now. I hope you all watched that video and can see why our copyright laws have been extended over the years. For copyrights, you would amortize the cost of the copyright over this time period. The next one we'll talk about are franchises and licenses. I'm sure you've all visited a business that was a franchise. McDonald's, Subway, Cold Stone, many restaurants and places like that are franchises. These are the rights that a company grants an entity to deliver a product or service under specified conditions. You would amortize the cost if there is a limited life for this. For instance, if the franchise or license is only for 10 years, you would amortize the cost you're spending over the 10 years. If it's indefinite, such as the franchise or license will never end, it won't expire, then you won't amortize the cost at all. We'll go over a few more of these. The next one is trademarks and trade names. These are words, phrases, jingles, or symbols that identify a particular enterprise or product. And I have a few listed here in the corner. We all know the symbol of an apple is for Apple, the company. We know that this M is for McDonald's. These are all trademarks or trade names for a company. A trademark or trade name will last for 10 years, but then the company can renew it. Therefore, really, these last indefinitely if a company keeps on renewing it. So we would not amortize the cost since it would have an indefinite life. Research and development is a very hot topic in accounting. This is actually not an intangible asset. It's going to be an expense. We're going to expense it as we use it. The reason why it's grouped here is because many companies look at this as an intangible asset. Think about the pharmaceutical companies that are spending billions of dollars developing new medications for us. They want to capitalize this cost with the invention, the medication, the product that they're making, and amortize it. But with accounting, since we do not know if that research and development will actually lead to a new invention or product, maybe all the research that a company does, it doesn't end anywhere. They never were able to complete their research. Therefore, we don't know if it will actually be able to get capitalized onto the cost of this asset. So in accounting rules, they just say expense these costs as you go. It's not an intangible asset. Last one we're talking about is goodwill. Goodwill does not mean that you're volunteering or giving money to Goodwill or the Salvation Army. It has nothing to do with charity. It's the amount by which a company's value exceeds the value of its individual assets and liabilities. Meaning the business is worth more than just the stuff that's in it. Maybe I've built up my business for years and it's extremely popular, and just the name of it is worth something. Unfortunately, we cannot recognize or own goodwill. It's only when someone else buys our company and they pay more for it than the value of the actual assets. For instance, let's say I had a hair salon and it's very popular and I've built it up for the last 30 years and all of these clients we have, and it just has a really great reputation, and I want to sell this business. I'm not going to just sell it for the property and all the stuff in it. I'm going to basically mark it up for its reputation and everything I've done to build this business up. The person buying it from me will put a value on the assets and look at what else they're spending on just the name for my business. That extra money is called goodwill. You can only recognize it when someone else purchases that business from you and they pay extra for it. Now, goodwill, we usually don't amortize. You're going to be learning more about this in intermediate accounting, so I'm not going to really go into detail with this, but for purposes of this class, we don't amortize it. The way the journal entry looks when we amortize it is the same way as depreciation. We're going to put the asset on our books, whatever the intangible asset is and whatever cash you're spending on it. Then each year, instead of depreciation expense, it's amortization expense. Instead of accumulated depreciation, it's accumulated amortization. I know it's a big word and everyone kind of gets confused with it sometimes, but just think amortization is depreciation before an intangible asset. We're just grouping it into a different category, that's all.